Okay, so the authors in this paper want to explore which of the models best explains the cross-section of returns in the Australian stock markets. Typically in the US, there's the FAMA French model, which includes the market return size and the value factor, and that's been studied in the Australia stock market. But in in the US, there's also the Fama French Carhart factor, which adds in momentum, and then some other studies have included liquidity factors as well. But the authors here want to study the four-factor model, the Fama French Carhart model, and the Australian stock market, which maybe hasn't been done before. And also, they've seen that the Australian stock market is somewhat integrated with the U.S. market, where the U.S. factors have somewhat of an influence on the Australian cross-section of returns. So they start digging in here at table 1, and this is the four-factor model where we have the market return, small minus big, which is the size, high minus low book to market values, which is the value factor, and then up minus down, which is the momentum factor. And we have it, the cross-section of Australian returns regressed on the U.S. factors, or I mean, sorry, the Australian factors, as well as the U.S. factors. And we see from the T statistics here that the Australian value and momentum factors were the ones that were most significant at the 1% level. And since there's no asterisks over here, we can say the U.S. factors didn't have any statistically significant influence on the Australian returns. But most of what the authors are getting at here is the high correlations between the US and the Australian factors. We see some pretty high, this is a correlation matrix here. So there may be some influence of the US factors on the Australian factors, so they want to dig a little deeper into that. So to explore that, they've added a third model. So basically, they have the US four-factor model, which we looked at before, the US four-factor model, which we looked at, and they added a combined model, which actually combines the four Australian factors, and they orthogonalized them, which means they just made it to where it doesn't correlate with the U.S. factors, and plus the U.S. four factors, for a total of 8 different factors, 4 of them from the Australian and 4 from the U.S. And they made a regression to include all of those, and they presented a GRS study as well as some R squared measures. And so the thought is that if a model fits well, meaning that all of its factors statistically significantly explain the cross-section of returns, the alpha of that model should be 0. And to test whether the alpha of each of the models is um, statistically likely to be 0, they do a GRS test. And if the factors um, likely fully explain the cross-section of returns, this GRS figure should be insignificant, so there should be no asterisk next to it. And we see that's not the case with any of the models. So that would mean that using the Australian four-factor, the US four-factor, and the combined model um, explain a lot of the cross-section of Australian returns, but there are some other things or other factors that are taking part in the returns, or that investors are taking, or that investors are considering when they make investment decisions, besides just these 4 factors in both markets. And in spite of that, we see that the combined model has the highest R squared, so it has the best fit of the factors. Those factors just don't fully explain the cross-section of returns. So we could say that the U.S. actually has some influence on the Australian markets since we have to use the combined model to get a better fit. And so since the combined model worked out the best, they've put together tables to dive deeper into the coefficients on each of the factors for each of the models. So, or for the combined model. So the combined model follows the Fama-French, and as we discussed before, it includes four of the Australian factors and four of the U.S. factors, and these are sorted into 25 different portfolios based on small minus big, so the size quintiles, and the high minus low, which is the value growth quintile. So this will be the book to market ratios. And so first we have the alpha of this regression model, and we see quite a few of the t-statistics over here for the alpha are significant. So we could say that the remaining factors and coefficients may not fully explain the returns in the model because the alpha has to soak up the remaining unexplained variables. But then we have the beta, which is related to the market return. This is the beta of the orthogonalized Australian returns. Actually, let's go down and look at the model so it's easier to understand what each of these variables is. So the model is this. We have the excess return, which equals the alpha, and then we have the four Australian orthogonalized returns. So 1, 2, 3, 4. It's the market, size, value, and momentum. And then we have the four US returns for the same factors, market size, value, and momentum. And then we have a few dummy variables. And so this table up here basically explains, or it shows the coefficient and t-statistic on each of these different factors. So okay, so let's go back up. So we have the alpha, so it's somewhat significant. So all these factors don't fully explain the returns, at least in the low book to market portfolios and the smallest stocks. Next, we have the market beta on the Australian orthogonalized variables. We see that all of the t-statistics are statistically significant at the 1% level. So we can say that the market factor has a big influence on explaining the returns. Same thing for small minus big. So the size is a significant factor. The value factor doesn't have as big of an influence because we don't have as many of the t-statistics, at least for the really for the ones that are characterized as value stocks, which would be the low, actually growth stocks, so low book to market. So these small and value related stocks seem to better explain the returns than the small low. And next we have the momentum factor of the Australian orthogonalized. So we can see that there's not very many asterisks over here, so the momentum of returns doesn't explain the returns very well, at least whenever controlled for the other factors. Next, we get into the U.S. factors. This is the U.S. beta, and we see that the U.S. market very significantly has a large part in explaining the Australian returns, which is interesting to see. We also have the size factors and the value factors. So these three factors in the U.S., the market size and value, play a large part in explaining the returns in the U.S. markets. That's kind of neat. And then finally we have the momentum factor that is in the U.S. market, and we see there's not many asterisks over here, so maybe the momentum in the U.S. market isn't very good at explaining the returns in the Australian market. And next we have the two dummy variables, and those end up being pretty statistically significant as well. So next, the authors decided to add a liquidity factor to the combined model, which I think they state hasn't been studied in the Australian market before. But we see here over here with all the T statistics that adding liquidity to the model, the liquidity factor isn't statistically significant and really doesn't explain or add much explanatory power to the regression. So next, the authors do a Wold test to see if the factors are actually significant in determining or explaining the returns in the Australian market, specifically looking at the U.S. factors. And here, since we have the um, asterisks here, we can see that each of the U.S. factors is in fact significant for explaining the cross-section of returns. And so we could say that the U.S. market actually does influence the returns of the Australian stock market. But when we add in the liquidity factors here, we see there's not many asterisks, so liquidity may not be a good um, or add much explanatory power to the model or explain much of the returns. So as we had found in the previous section, the U.S. has a large part in explaining the returns. And so to wrap this up, the authors used a different sorting methodology um, in a paper by Brailsford a while back, and they used the same Australian four-factor, US four-factor model, and the combined model to do the same GRS test. They just sorted the portfolios differently using the same factors, and they found that the US four-factor model works out the best for explaining Australian stock market returns. We see that here because the GRS is insignificant, so that would tell us that the alpha um, is most likely 0, which would mean that the four U.S. factors fully explain the returns of, or likely fully explain the returns of the Australian stock market returns, and therefore concluding that the U.S. has a very large influence on the returns of the Australian stock market.